You are sitting across from a senior partner at a firm that manages $2 billion in assets. You have prepared for this meeting for 3 days. Your analysis is clean, your model is tight, your assumptions are documented and defensible. You walk him through every slide. He listens without interrupting. At the end, he asks you one question, not about your numbers. He asks you why you built the model the way you did. You do not have an answer. You have outputs. You do not have a philosophy. That gap between producing analysis and owning a philosophy is the entire distance between an analyst and an architect, and closing it takes longer than most people expect. The analyst stage begins with information, specifically with learning how to process more of it faster and more accurately than the person next to you. You learn how to read a balance sheet the way a mechanic reads an engine. You learn what healthy margins look like in a manufacturing business versus a software business versus a capital-intensive infrastructure play. You learn discounted cash flow modeling, comparable company analysis, precedent transaction multiples. You build the technical vocabulary that the investment world runs on. This stage is necessary. There is no skipping it. The architect who never went through the analyst stage is building on sand. But the analyst stage has a ceiling, and most people inside it cannot see the ceiling because they are too focused on the floor. The floor is the work itself, the models, the memos, the research, the pitch decks. The floor keeps you busy every hour of every day, and busy feels like progress. The ceiling is the point at which technical competence stops being the differentiator. In the early years of any investment career, being the most technically precise person in the room is genuinely valuable. Then you reach a level where everyone in the room is technically precise, and something else entirely determines who makes the best decisions. That something else does not have a clean name. Some people call it judgment, some call it pattern recognition, some call it investment philosophy. What it actually is a framework for making decisions under uncertainty that is yours, built from your own experience and thinking, not borrowed from a textbook or copied from a mentor. The analyst borrows frameworks. The architect builds them. And the construction process is not comfortable, and it is not fast, and there is no course that walks you through it step by step. The first crack in the analyst identity usually comes from a loss, not a paper loss on a model, a real loss on a real position where everything in your analysis said it should have worked. The numbers were right. The thesis was sound. The management team was credible. The market moved against you anyway and kept moving, and eventually the position was exited at a loss that was large enough to require explanation. You wrote the post-mortem. You identified the factors you missed, and somewhere in that process, you realized something unsettling. You had been modeling businesses without fully understanding them. You had been producing outputs that looked like understanding, but were actually very sophisticated descriptions of surface-level data. This realization is the door between the analyst and the next stage. Not everyone walks through it. Many analysts respond to this realization by becoming better analysts. They tighten their models. They add more variables. They build more robust sensitivity analyses. They address the symptoms of the problem without confronting the problem itself. The problem is not the quality of the analysis. The problem is the relationship between the analyst and the asset. It is still transactional, still external. The analyst is still looking at the business from outside the glass. The architect eventually steps through the glass. Stepping through the glass means developing what experienced investors call a proprietary lens. A proprietary lens is a specific way of seeing a category of assets that is built from direct experience rather than secondhand research. It comes from spending enough time inside a specific industry or asset class that you understand the operating reality, not just the financial representation of it. You understand why margins compress at a specific revenue threshold in that type of business. You understand which line items in the income statement are real and which ones are accounting artifacts. You understand what the management team is not saying in the earnings call and why they are not saying it. This kind of understanding cannot be modeled. It can only be developed through time and direct exposure. The transition period between analyst and architect is the most uncomfortable phase of an investment career. You are no longer satisfied with the analyst work, but you are not yet confident enough in your own framework to act on it decisively. You sit in meetings, and you hear the consensus view, and something in you disagrees, but you cannot fully articulate why, and you are not yet sure whether your disagreement is insight or error. This uncertainty is not weakness. It is the necessary friction of developing independent judgment in a field where independent judgment is the most valuable and most difficult thing to build. During this transition, you start doing something analysts rarely do. You go to the source. You visit the businesses you are analyzing. You talk to the people who actually run the operations, not the investor relations team, not the CFO preparing for a roadshow, but the regional managers, the logistics coordinators, the frontline employees who know whether the company's stated strategy is actually being executed on the ground. You read the court filings and the regulatory submissions and the trade publications that nobody in the investment committee meeting has read. You are building a picture of reality that is more granular and more honest than anything a model can produce. The architect stage begins when you make your first genuinely contrarian call, and you are right. Not right because the market eventually validated your thesis after 2 years of patience. Right in the specific way you predicted through the specific mechanism you identified on roughly the timeline you modeled. This kind of precise correctness is different from being generally right about a direction. It means your framework captured something real about how value is created or destroyed in that specific situation. It means you are not just processing information, you are generating insight. Insight generation is what separates the architect from the analyst at the operational level. The analyst's output is a description of what is. The architect's output is a thesis about what will be and why. The analyst answers questions. The architect identifies which questions matter. The analyst tells you what the numbers show. The architect tells you what the numbers are not showing and why that gap is where the opportunity lives. These are not small differences in communication style. They are fundamentally different cognitive activities that require fundamentally different development paths. Capital allocation is where the architect's thinking becomes real in a way that analysis alone never is. When you are allocating your own capital, or capital you are accountable for, every decision carries weight that a model never does. The model can be revised. The capital cannot be undeployed without cost. This weight is not a burden to be minimized. It is the pressure that sharpens judgment over time. The investors who developed the most durable track records in history did not develop them by running better models than everyone else. They developed them by making allocation decisions under pressure across enough cycles that their judgment became genuinely calibrated to reality. The architect thinks about portfolio construction differently than the analyst does. The analyst evaluates individual positions. The architect evaluates the relationships between positions. The architect asks how this position behaves if inflation accelerates and the two positions already in the portfolio also move against the thesis simultaneously. The architect asks what the portfolio looks like in the scenario where the consensus is completely wrong about the direction of interest rates. These are not stress tests applied after the fact. They are design constraints applied before the first dollar is committed. The portfolio is not a collection of good ideas. It is a structure with intentional properties. The concept of variant perception is central to how the architect operates. Variant perception means holding a view that differs from the consensus and being able to explain precisely where your view diverges and why your information or reasoning leads to a different conclusion. The analyst can describe the consensus. The architect can tell you where the consensus is wrong and what evidence would confirm or deny that divergence over time. Variant perception is not contrarianism for its own sake. It is not disagreeing with the market, because disagreement feels intellectually sophisticated. It is a specific, documented, testable claim about where the market's current pricing does not reflect the underlying reality. Position sizing at the architect level is a direct expression of conviction, and that conviction is built from the quality of the variant perception underlying the thesis. The architect does not size positions based on how good the idea feels. Positions are sized based on the quality of the information advantage, the margin of safety embedded in the entry price, the liquidity of the instrument, and the correlation with existing exposures. Each of these factors has a specific effect on the appropriate size. This is not a formula. It is a judgment framework that gets more precise with every allocation decision made and reviewed honestly. The architect also thinks about time differently than the analyst. The analyst operates in quarterly cycles because that is when earnings are reported and performance is measured. The architect operates in business cycles and secular trends that play out over years and sometimes decades. The ability to hold a position through short-term volatility because the long-term thesis remains intact is one of the most economically valuable skills in investing and one of the most psychologically difficult to develop. It requires a level of conviction in your own framework that takes years to build and is constantly being tested by markets that are indifferent to your timeline. Tax efficiency enters the architect's thinking in a way it never enters the analyst's. The analyst evaluates pre-tax returns. The architect evaluates after-tax, after-fee, after-inflation returns on capital, because those are the only returns that actually compound in a way that builds lasting wealth. The structure through which investments are held, whether inside a tax-advantaged account, a partnership structure, a trust, or a corporate entity, has a direct and significant impact on the actual return realized by the investor over a long time horizon. The architect designs the structure before making the investment. The structure is part of the investment thesis. Risk is where the difference between analyst and architect is most visible and most consequential. The analyst measures risk as volatility, or standard deviation, or value at risk. These are statistical descriptions of how much prices have moved historically. The architect understands that those measures capture the risk that is easiest to quantify and miss entirely the risks that are most dangerous. Liquidity risk, counterparty risk, regulatory risk, the risk that the business model becomes obsolete before the thesis plays out, the risk that the management team's incentives are not aligned with the capital structure in a way the proxy statement does not reveal. Identifying and pricing these risks before they materialize is what the architect's edge is actually built on. The relationship with uncertainty changes completely at the architect stage. The analyst is trained to reduce uncertainty through more rigorous analysis, more data, more variables, more precise modeling. The architect understands that uncertainty cannot be eliminated, and that the attempt to eliminate it through analytical precision creates its own specific failure mode. Over-optimization to a single scenario. The architect builds investments that work across multiple scenarios, not perfectly in any one of them, but adequately in all of them. Robustness across scenarios is worth more than optimality in the base case. The architect's relationship with being wrong is also fundamentally different. The analyst experiences being wrong as a failure of analysis, a mistake in the model, an assumption that did not hold. The architect experiences being wrong as information. The thesis was tested by reality, and reality disagreed. That disagreement is a signal that the framework needs updating. The update makes the framework more accurate. The more accurate framework produces better decisions going forward. Being wrong is only permanently costly if you do not extract the information embedded in the error. At the fully developed architect stage, you are not looking for investments. You are creating conditions under which investments find you. Your reputation in specific markets, your relationships with operators and founders and other capital allocators, your track record of adding value beyond capital, all of these things generate deal flow that is not available to anyone running a screen on a Bloomberg terminal. The quality of proprietary deal flow is the single most durable competitive advantage in private markets, and it is built entirely from the credibility and relationships accumulated over years of operating with integrity at every stage of the investment process. The architect eventually reaches a stage where the work becomes about building systems that outlast individual decisions, a framework that other people can be trained to apply, a portfolio construction methodology that can be stress-tested and refined across market cycles, a set of decision-making principles that are documented and teachable. This is the transition from architect to institution, and most individual investors never reach it because it requires a level of self-awareness and intellectual honesty about your own process that is genuinely rare. You are sitting at the desk now, not across from the senior partner, behind your own desk. The capital is yours to allocate, or the mandate is yours to execute. The model is open, but you are not looking at it. You already know what the model says. What you are thinking about is what the model cannot say, what the number does not capture, what the management team's body language told you in the meeting last week that the transcript will never convey, what the industry contact said offhand at the end of a call that changed how you see the entire competitive landscape. You are weighing things that have no column in a spreadsheet and arriving at a conviction that is entirely your own. That conviction is the product of every year of analysis, every position that worked, every one that did not, Every post-mortem written honestly, every framework revised after being tested by reality. It did not come from a course or a certification or a mentor who handed it to you. It came from the slow and often uncomfortable process of building your own relationship with how value actually works in the real world. The analyst reads other people's maps. The architect draws their own. And the map you have drawn, revised, redrawn, and refined over years of honest engagement with markets is the only edge that cannot be copied, automated, or arbitraged away by someone with a faster computer and a larger data set. It is yours, and it took everything you had to build it.